Hello everybody and welcome to our Grow Your Law Firm webinar, Thinking of Incorporating Your Legal Practice, Part 1. My name's Matt Sleater from FWO Chartered Accountants. We are a chartered accounting firm that specialises in providing accounting services and accounting support to 1 to 3 sized principal firms throughout the eastern seaboard of Australia. So thank you very much for taking your time out today to attend our webinar. Just a couple of very quick questions before we get started, just to see who's attending today. So if you could just tick the box to let me know whether or not this is your first Grow Your Law Firm webinar that you've attended. For those of you who are coming back, thank you very much for your continued support. Glad you're getting some value out of these. And for those of you who are first-time attendees, welcome. And there's a whole pile of information and past webinars on our website that you can access in terms of looking up past webinars. So, look, thank you very much. We have about 1/3 of people attending today are new participants. So welcome. And lastly, just to get a bit of a clear picture as to why you're considering incorporating your legal practice, as to whether or not you're thinking about succession, the old favourite of paying too much tax, starting out, some debt to restructure, or there's some other reason. So just a couple more seconds and then we will get underway. Excellent. So thank you very much for voting on that. So in terms of the results, it's pretty much as I usually see. Not sure how those numbers stack up. That looks a little bit weird. Must be some little glitch. But we've got there's multiple answers here, and the main drivers, which is usually the case, it's ILPs are often looked at when it's time to look at succession and tax structuring, given the inherent legacy structures that are in place. So let's get into it. So these webinar on incorporating your legal practice is over 2 parts. Today we're just going to be working through an introduction to what incorporation is about, what I see with firms as to why they incorporate, give you a little bit of an insight into some of the things you've got to be aware of when you're incorporating, and then in the second part we'll run another webinar in a month's time, and we'll go into a whole bunch of detailed and worked examples around what those opportunities are and how they can how you can take advantage of an ILP. So what is an ILP? It's basically just it's called an incorporated legal practice, and the reality is it's just you're operating your practice through a company. Prior to the early 2000s, and then in Victoria and New South Wales in 2007 in Queensland, you were obliged to operate your practices in either as individuals or a trust with you as individual trustees, and you could not operate as a company. So these laws came in between 15 and 10 years ago, and now allows you to operate your practice through a company. And what I see in firms is that when firms are getting established now, they're just getting established as an incorporated legal practice. There is still a significant amount of firms that continue to operate through their legacy entities, and what I mean by that is they're either partnerships of individuals, they're service entities, or they're sole traders, and so on. And those legacy entities really are an inefficient way, in most cases, of operating your practice. So today we're just going to be focusing on what an ILP is, what are the issues that you need to consider and what you need to think about. And one of those things is, for your practice to continue to operate through an ILP, you've got to have at least one Australian legal practice director. Okay, so why would you consider an ILP? The first one is succession. So most of the inquiries that I receive from legal firms when they're considering an ILP is that they've got some sort of succession event happening. Whether or not that is a retirement or an exit of a partner, whether or not that's an acquisition or a merger for succession purposes, and whether or not it's a new principal coming in and buying some equity in the practice. Usually that's the number one reason that sparks people to stop and think, do I need to consider an ILP? What's the most effective way of doing this? Secondly, asset protection. For a very, very, very long time, most businesses in Australia have been able to operate their businesses as through a company structure. Some of the professions have taken a little bit longer to come on board with that. One being the legal fraternity. So since those laws were changed, lawyers now can avail themselves of the asset protection that is provided by operating the practices through a company. It's a modern, effective structure. As I just mentioned, the structure has been around for a very long time for the rest of the world, operating your practice through companies. But now for lawyers, it's a matter of looking at it and saying, well, is the structure that I've got modern and effective? I'll run through a couple of examples of that shortly, but mainly it's around the tax efficiencies of it. Mainly it's around the ability for distributing income. It's around the ease by which you can enter and exit the structure, and lastly, it's very much also about the ability to have non-lawyers being owners within that practice. So let's talk a little bit more about succession. So first up, it's whether or not your existing structure is inefficient. And look, most firms that look to structure into an ILP have got either they're usually either an individual as a sole practitioner who may have a service entity, or they are a partnership of individuals and with a service entity. Believe it or not, I have worked with many clients over the last 5 or 6 years when we're incorporating their firms, where they're just operating as a partnership of individuals with no service entities whatsoever. Going back to about 2007, 2008, the kibosh was basically put on service entities by the ATO when they announced the rulings around markups on service entities. So they really became a defunct entity to use in any sort of structuring. But what a lot of firms have continued to do is they've just continued to run their practices as they previously were. A couple of other changes that need to be considered also when thinking about your existing structure, and particularly when you're operating a practice as a partnership of a discretionary trusts or a mixture of a partnership of discretionary trusts and individuals. Since 2009, there were changes with the laws in relation to Division 7A of the income tax laws, basically which meant that if you're making distributions from a discretionary trust to a corporate beneficiary, those now fall within Division 7A and are required to be paid out as effectively loan repayments paid out as dividends over 7 years. So that was another change that then made partnerships of discretionary trusts a little bit more inefficient, because prior to that we were able to park profits in corporate beneficiaries at the 30% tax rate and just leave it there. From that date on, there was a time frame of 7 years that we then needed to clean those profits out. The difference with a company, a practice operating as an ILP, that an ILP doesn't have those rules. If they're just retaining the profits within the company and not pulling them out, then that Division 7A doesn't apply. So it can have a significant impact on efficiency and tax planning. What it also gives, it gives continuity for future succession. So So in the past where we've got entries and exits to partnerships, often those partnerships would have to keep 1, 2, 3, 4, 5 sets of books, depending on how many partnership changes occurred. And usually this was in relation to the billing and collection of WIP and debtors. So the WIP and debtors generally would stay with, and unbilled disbursements would stay with the old firm, and then the new partnership would be established. They'd start building their WIP and debtors from them, funding their working capital. There's a change in that, then that WIP and debtors that relate to that partnership would stay with that partnership, and so on. What an ILP allows it to happen is it just allows the continuity of ownership, because you buy and sell shares in the company, so it allows the company's assets, which include WIP and debtors, just to be continued on. You need to make sure the valuation methodology is right around the recoverability of them for if you're an incoming shareholder. However, it just allows that continuity of the business to continue and keeps that very simple. And that occurs, as I said, by buying shares. So the company would generally be established with discretionary trust as the shareholder, or discretionary trusts for each of the individual principals as their shareholders in their equity portions. And then if you are looking at buying and selling those, or bringing in and exiting principals out of the firm, then those transactions can occur just simply by buying shares or selling shares. You no longer have to sell a fractional interest in each and every asset of the partnership, nor do you have to then assume a fractional interest of each and every liability in that partnership. So it allows that the mechanism of buying and selling shares makes succession so much easier. And it also allows an efficiency of debt funding, because you've got continuity of the business just continuing on as it is. Quite often when we're restructuring firms for succession reasons into ILPs, we take a step back and have a look at what the funding structure is for that business, because often when you've got new principals that are coming into a firm, there's not necessarily the ability for them to access the cash to buy out existing principals or take an interest. So often what we're able to do is we're able to structure debt within the company on the transaction of restructure that allows the capital value on the goodwill that's being acquired to be released to the existing owners and to fund that transaction. So what I'll actually do in our part 2 in a month's time, I'll be showing you some examples of that as to how that can work on how you debt fund a restructure of your practice to unlock capital. And as I said before, it often allows for non-lawyer shareholders. So long as you've got an Australian legal practice director, you can have non-lawyer shareholders owning your shares within that company. So sometimes that's a driver for succession for various reasons. Maybe that's looking at strategy for raising some capital, or strategic alignments with other businesses, maybe with accountants or financial planners or whatnot. But what you've got the ability then in a legal firm that's an ILP is to have non-lawyer shareholders. They can also have non-lawyer directors, so long as you've just got that single, at least that single Australian legal practice director. So succession really is one of the big drivers to why people consider looking at switching over to an ILP. From an asset protection perspective, this is quite straightforward. You've got limited liability as a shareholder in the company. You still have all your responsibilities and fiduciary responsibilities as a director of the company. However, when it comes to the exposure of the personal assets of the shareholders, you have that limited liability. Whereas if you are a shareholder, a partner in a partnership, an individual partner, say in a partnership, then you've got that joint and several liability that exists. So that's that's a major plus around the asset protection. Yeah, sure, you know, there's still insurance issues. There's still personal responsibilities of the directors of the company, but basically you get that asset protection from limited liability. And also then what you can do is you can have a trust as a shareholder. So if you've got individuals who are the partners in the partnership, then basically those individuals is where they own the capital, they get the income. So when you've got trust as shareholders, you have that ability to reduce your exposure personally as a director by making sure that your interest in the company is held within a trust. So no longer will you have that personal exposure of assets that you have via a joint and several individual liability. So asset protection is the main one. Modern effective structure. So it's really just shifting that ability to get into a structure that provides you with the ability to retain profits. So as lawyers, and those of you who might practice commercial law, and you know there are only, or corporate law, there are only two types of people as far as the corporations law is concerned. That's individuals and companies. So what we have with an ILP is we have an ability for the company to own assets and to operate a business, and those companies are taxed at a corporate tax rate compared to individuals. Well, individuals are taxed at the marginal rates of tax. Trusts are only taxed on income that isn't distributed, and that's taxed at the highest marginal rate. But on income that's distributed, it is then taxed at the rate for which the beneficiary's marginal rate or corporate rate which they are taxed. So with the changes that have been made, particularly of recent times, the small business concessions that have been changed with by the government at the last election, companies now who have got turnover of less than $10 million are only taxed at 27.5%, and over time, over the next number of years, I think it's about 2022 or 2023, somewhere around that mark, that 27.5% tax rate will reduce to 25%, and that will be for all companies. So what you have is you have a structure that provides you with an ability to retain much more of your after-tax cash flow. And again, in part 2, I'll show you some numbers around this on the 15th of November, and it'll show you the effective benefit that you have to fund your working capital, or to fund your expansion, or to fund your debt reduction by doing that out of a much lower tax environment. So this modern effective structure for a legal firm, being an incorporated legal practice, allows you to manage your after-tax cash flow better. In saying that, any dividends that are paid out of your company to your trust and then are distributed out to the beneficiaries, ultimately then are still taxed at those beneficiaries' rates. But if you're not pulling those monies out, then and you're using that to grow working capital, which is often the case in litigation style firms, maybe a family law firm or a PI firm. So where they're funding significant amounts often of WIP and debtors, it provides better cash flow for doing that. And then if you're on a debt reduction program, it gives you a faster ability to reduce that debt. Secondly, it provides you with an efficient profit distribution strategy. So provided that you have an ability in the company, and I'll touch on this in a moment, but provided you have an ability in the company to distribute income over a range of beneficiaries of your trust shareholder, you have the ability to, one, determine when those dividends are paid out of the company. It doesn't automatically get paid out to your your shareholders, and when they are paid out to the trust shareholders, you then have an ability to determine that distribution strategy. So that then gives you flexibility around your tax planning. Whereas if you're operating your practice via individuals, as an individual or a partnership of individuals, and if there's a service entity which will give you minimal, if any, ability to split income, those profits must be distributed to the partners in accordance with their equity holdings, unless there's a variation that you make to that in writing in terms of partner salaries and the allocation of profits that way. So you've got them flexibility, and you're in control of the timing of when income or those profits land into the ultimate beneficiary's hands, because you've got timing over the dividend policy and the dividend timing. You've also got then the ability to distribute that income to a range of beneficiaries of your trust. You can have your debt funding localised in your ILP. So what I mean by that is, if you've got a strategy to restructure to an ILP and you need to borrow to do that, that funding can then be borrowed by the company specifically, not by the individuals as partners in a partnership. You can borrow that money individually and then work on its debt reduction strategy. And quite frankly, banks will lend you money on your practice. You know, I work with some banks when some clients are looking to restructure. I have no alliance to any bank, but I know the bank lending, some of the bank's lending policies, and you know, there's Westpac, for example, that has a lending policy for legal firms where they'll look at a security limit, and lending up to that limit equal to 60% of the previous year's fees. There are a bunch of other conditions, but banks will lend you securing money against the goodwill of your practice. So that's debt funding, and also from a simplicity perspective, it allows you to operate via a single entity. So if you've got these multiple entities, multiple partnerships that exist because of prior changes to partnership interests, or you've got a partnership and a service trust, it effectively allows you to collapse all of that and just operate everything via a single entity, which simplifies over time. So let's have a look at how the transaction works, and it's quite a simple transaction. So basically, what you've got is you've got the old firm, whatever sort of structure of the practice it is, and you've got an incorporated legal practice. Basically, what happens is you've got the ILP purchases the goodwill, fixed assets, and assumes employee entitlements and asset finance. So if you've got for example, your computer's under an existing lease or under a HP, then the ILP will buy those fixed assets and assume that lease and will take over all of the employee entitlements. Generally what you do is you value the practice to assess goodwill. You've got to do that for stamp duty and, if it's applicable, stamp duty and capital gains tax reasons. But it's just a transaction that's a simple business conveyance, as it ordinarily would be, selling the practice business assets across to the ILP. And that can often just get funded via internal vendor finance debt or via bank debt, or a mixture of both. What happens in the old firm, it then retains all the other assets and liabilities. So the old firm retains its work in progress, it retains its debtors, its unbilled disbursements, it keeps its cash, it pays out all of its liabilities, and then it can determine what it does with that cash, whether or not it keeps it outside of the ILP or lends some of that money into the ILP to fund its working capital. Alternatively, your working capital can be funded via bank debt as it grows within the ILP, or a mixture of bank debt and vendor finance, or all vendor finance. So you've got that flexibility. Now, there's a couple of reasons why we do that. One is stamp duty. In New South Wales and Victoria, that stamp duty wouldn't apply to that transaction. In Queensland, you'd pay stamp duty on the transfer of goodwill as it be, of WIP and debtors as they attach to the goodwill of the business. But the main driver, and that's a pretty significant one if you're based in Queensland, but the main driver is that if the old firm sells its work in progress and gets paid for it, so first of all, if the old firm is on an accruals basis for paying its income tax, then as soon as it enters into a contract and sells that work in progress, it turns it into revenue, turns it into income, tax assessable income, which you pay tax on. So you just don't want to do that. And alternatively, if you sell it across, and you're on a cash basis, as you receive cash for that payment, whether or not it's ultimately billed or not by the ILP, you will also start paying tax on it. So we generally leave those assets outside just to keep the transaction simple and to quarantine those assets from bringing forward tax liabilities. Very important, I'll just say as an aside, it's very important when you're looking at doing an ILP restructure that you understand the future tax cash flows of work in progress and debtors. And I'll point this out and show you in the next webinar. But just to give you a little bit of a heads up, if you're a firm that carries a significant amount of WIP, so an unbilled disbursement, so let's say you're a personal injuries firm, and you could carry anywhere between 18 months and 2 years of WIP, which basically means 18 months to 2 years of revenue. So when you look at what happens within an ILP, it's going to build up its WIP and debtors over time. So what you end up having is your old firm having all of this conversion of its WIP and debtors as that WIP as it gets billed out, and it becomes taxable. But there are no expenses that are offset against that taxable income anymore. They're all in the ILP. So within the ILP, you've got this work in progress that's growing. It's not taxable till it's billed, so there's no taxable income being created. But you've got all these expenses that are in there, and they're tax deductible. So what you can end up with poor planning is you can end up having a situation where the old firm has got all this taxable income, and you're paying a pile of tax at your marginal rates of tax, and you've got tax losses that are sitting in within the ILP. So we've got to be mindful of that sort of thing in tax planning. There's some possible solutions to that if the small business CGT example rules apply and your old firm operates via a partnership of trust. There's potentially an ability to deal with that without crystallising any income tax in the old firm. But all I'm saying is you've got to map out your tax cash flows. You've got to understand the tax implications of doing that. So generally what we do with firms when we're restructuring them into an ILP is we map out those 3 years tax cash flow so the informed decision is made around what really happens with all of that income. So the issues you need to consider. 1 is capital gains tax. 2 is stamp duty. 3 is funding. And number 4, you really need to consider your distribution strategy. So I'm just going to touch on these briefly because particularly in relation to capital gains tax, it is an extremely complex area and you need to make sure that when you're doing your restructure that you understand the CGT implications to the business as it is as the assets it is selling, so goodwill in particular, and also to the partners individually as to what those CGT implications are for them, because they are very many and varied depending on asset values, turnover amounts, structure, age, and so on. So let's look at those quickly individually. So from a capital gains tax perspective, often when you restructure to an ILP, it can be done without creating a capital gains tax liability. This can occur via applying the normal rollover provisions, depending on the structure and the restructure transactions. or if the small business capital gains tax exemptions apply. So usually we find, and you know, as I said, I specialise in working with 1 to 3 sized principals. I do have other legal firm clients that are larger than in that size, but generally when I'm finding in the 1 to 3 principal size firms, usually the small business CGT concessions in one way, shape or form will be able to be applied to a transaction where those practices have been established after September of 1985. So you've got to have a look at the small business CGT concessions, and with those CGT concessions, the fundamental thing is if your practice has got turnover of less than $2 million and other entities that are connected to your practice or affiliated with your practice, and when you combine their income it's less than $2 million, then the small business CGT concessions can apply. If it's over that, and depending on your structure, whether or not, and depending on the ownership percentage you have in your practice, so if you own more than 40%, if you're a partner in a partnership and you own more than 40% of the practice, and 100% of those assets are taken into account, those net assets are taken into account when calculating whether or not you meet a $6 million net asset test. So many variations to it, but fundamentally, if you're over 55, you should be able to, and the small business concessions apply, you should be able to restructure your business without having any capital gains tax impact, and you have an ability, if you choose, if you're over 55, to put some of that capital gain into superannuation as a tax-free contribution that isn't included in your contribution caps. And if it goes in there, if you've already got $1.6 million in super, then that is not included as part of your cap. So it's not regarded as a non-concessional contribution. If you're under 55, then you need to have a look at how you apply the concessions. There are rollover concessions, there are 50% reduction concessions, and small business retirement concessions that if you choose to use that, you will need to look at how you are going to fund a contribution into superannuation, and often that can be funded via worked out by how you fund the goodwill restructure into the practice. So you can utilise, and this is why the small business CGT, one of the reasons why the small business CGT concessions are designed like they are. So it helps people to utilise superannuation and shift capital into superannuation for planning for retirement, because it's recognising that often these transactions, like because of succession, as a driver of restructuring to an ILP, it recognises that this is often done as part of a retirement strategy for practitioners. So you can utilise it. So you've got to be really careful around that. There's very specific rules to make sure they comply, and if you mess it up, then it can have drastic implications for you. But superannuation as part of your strategy, it's a very effective way for building your superannuation. So CGT needs to be considered. Stamp duty, look, basically it's payable on business transfer in Queensland, but not in New South Wales or Victoria. And I don't really spend much time working in the other states. But from memory, I don't think there's stamp duty in South Australia, and I've got no idea in Western Australia. But please don't quote me on that if you're from South Australia and I'm incorrect. So you've just got to be aware of that. Now, but usually what I find so if I'm talking now just to the people who are listening in, who are from Queensland, what you've got to do when you look at stamp duty, you've got to look at it and consider all of the other benefits and all the other outcomes that you achieve via an ILP restructure. Usually what I find when you look at the entire structure and you look at superannuation strategies, when we look at how debt gets managed, how debt gets repaid faster, how you can convert non-deductible debt to deductible debt, when you take into consideration all of these other benefits and opportunities. Mind you, tax can never be the driver of this. You can end up finding yourself in a little bit of Part 4A problem if that's the case. But there, it does have some other tax benefits. There are tax benefits that do relate to an incorporation, but you've got to actually weigh all of the costs and benefits together. And usually, what I find with most firms, that where an ILP is suitable for their strategy, usually if there's stamp duty payable, then the savings that occur are usually, I can't guarantee it, but usually that stamp duty cost is caught up within a 12-month period. So, it becomes very cost neutral very, very quickly. Then from a funding point of view, so you can look to utilise your bank funding for the purchase of goodwill and fixed assets. So basically, and I'll show you this with some numbers in our next webinar. But if you think of it like this, that you've got a purchase of goodwill for $1, let's say it's worth $500,000 goodwill and $100,000 worth of fixed assets, and you've got $50,000 worth of employee entitlements and finance facilities assumed. So you've got a $550,000 purchase price. That $550,000 purchase by the ILP can be funded by debt. So if you borrowed $550,000, paid it to the old firm, then the old firm can use that money for various things. It can distribute out that capital profit out to its to the partners. Those partners could put that money into super. They could retire debt with it. A whole range of things. So basically, using debt funding in this structure allows you to unlock cash to use in your planning. So it's something that you, as I said before, when you're considering the implications of incorporating your practice, you must consider the upstream benefits that you get and what it allows you to do. Also, from a working capital perspective, what it allows when you sell the practice across from the old firm to the ILP is you can then make some decisions around what happens when you bill your work in progress and unbilled disbursements and collect them from debtors. We've had all these years, and often working capital has been built up from retention of profits as opposed to being funded from debt. So usually there's all of these profits that have been earned. Tax quite often paid at 47 cents or higher in the dollar. Some years we had 49, and they've paid tax on those profits, but haven't been able to access the cash. So there's the ability for looking at how you're going to fund the working capital growth in the ILP. Do we do that via, as I mentioned earlier, do we do that via a mixture of overdraft debt from the bank, or do we do that and vendor finance from working capital collected outside in the old firm and put into the new firm, or do we fund the whole thing via debt, or do we fund the whole thing via working capital? Those options are available. So basically what it allows you to do when you look at your funding strategy into the future under this ILP in the new practice, we've got new principles in there, or for whatever other reason you're looking at incorporating, you have the ability to say, okay, we've got these assets, what are we going to do with them? Are we wanting to unlock some cash to utilise for our personal planning or other strategic actions? Or are we just wanting to just continue on with our funding strategy as it is, and we're comfortable to put that cash across into the ILP? So lastly of those four things that you need to consider is also your distribution strategy. Over the last week, since we've emailed out the invitations for this webinar today, I've had a number of questions that have been raised by a number of you who are listening today, and particularly it's around how income gets distributed out. I've had some emails, some phone calls, and you've got to be aware, first and foremost, that just because you operate as a company doesn't mean that you have an ability to pay tax at the company rate. So there's another step, sad to say, that you've got to go through. And basically there's an income tax ruling that talks about when an entity, or a company, when an entity is able to retain its profits and and distribute its profits because it's regarded as business profits. So it's looking at whether you've got business profits versus personal exertion income. And the fundamental rules to that are that for a professional firm, if you've got at least the same number of full-time equivalent professional fee earners, non-principal professional fee earners, as you do principal professional fee earners. So if you're a sole practitioner and you've got one full-time solicitor and you've got yourself as a full-time solicitor as well, one of you principal, one of you not, then your income will be regarded, or the profits that are made within your practice will be regarded as business profits, and you will be allowed to retain those profits within the company. If you've got non-professional, non-principal employees, for that rule to be satisfied, they need to be making a significant material contribution to the revenue of the firm. So, for example, if you're a sole practitioner and you've got a legal secretary, it's extremely unlikely that you'll meet that business profits rule. So what happens in that case, if you don't meet the business profits rule, then you are not able to retain those profits in the company and use the corporate tax rate. You basically need to flush those profits out. Generally, you do it as wages each year so that you're taxed on those profits at your marginal rates. Just because you start out like that doesn't mean that it always ends up like that, because usually when you're starting out in your practice, you're looking to grow it. So eventually you'll get to that point at some point in time when you're going to employ somebody, and as soon as you start employing solicitors, then you're able to look at applying the business profits rules. So that's the first thing. So where you have an ability to retain your business profits, you've got to be mindful of how you distribute it there. So there was some ATO guidelines that were released about, was it September 2014. I've written an article on that that's on my website, and basically what the ATO have done is they've effectively legislated by guidelines. They've basically said, okay, provided we're going to assess how profits are distributed out of firms, we're going to assess the likelihood of audit and compliance action taken by them against the firm as either a low risk or a high risk. And if you're a low risk, then you generally are not going to have any, and you meet these guidelines, you're not going to have any audit compliance requests. If you are of high risk, it means you don't meet these guidelines, then expect a knock on the door. So they didn't legislate that this is what you had to do. But all they're saying to you is if you can follow, if you meet these guidelines, we're going to be comfortable with that. And basically, there's one of three tests that you need to meet each year, and you can meet one of these three tests differently. You can meet a different test each and every year, but so long as you meet at least one of these tests. And all they're saying is depending on your structure, so you're an IOP, and this applies to you at the moment, to every practice other than a sole practitioner operating in their own right without a service entity. So if you're a sole practitioner and you've got a service entity, then these rules apply to you. If you're a partnership of individuals, this applies to you. If you're a partnership of trusts or it's only if you are a sole practitioner and that's all you are, no service entity, that's when these tests won't apply to you. So if you operate as a company, these rules apply. First one is a commercial remuneration test. And all that means is that what ends up in your tax return is commensurate to a commercial remuneration, whether it's paid to you by wages, the super and dividends, or trust distributions, whatever it might be, so long as that is commercial. There's various rules around that where you look at if you've got people who are employed within your business that do the same sort of work as you, and you've got to be looking at the upper quartile of those people. So there's some rules around that. Alternatively, it's just your normal commercial rules for what someone will be paid to do what you do in your firm. So long as, one, that lands in your tax return, no problem. Alternatively, there's a 50% profits test. So if at least 50% of what your equity entitlement to is in the business lands in your tax return, then that's okay. So let's say you're in a practice, you're a sole practitioner, and you've had a poor year, and you've only made a profit of $50,000 for some reason, but you've got an ability to split your income and retain business profits. So long as at least $25,000 of those profits that end up in your tax return, it doesn't matter that that's not a commercial salary to or a commercial remuneration. You meet the 50% test. But if you're in a business that made your equity shares $1 million, then to meet that test, you've got to actually pay tax personally on distributions of income via salary, dividends, distributions of $500,000. And the last one is a 30% effective tax rate test. So it looks at you and your associates. So if you're going and if you're paying out a dividend, and that dividend doesn't meet the 50% profits test, and you're not getting an amount of income in your return that meets the commercial remuneration test, if you look at your tax rate and the tax rate of the other people who you are distributing to, and as long as your effective tax rate that is on those distributions of profits is 30% or more, you can tick that box. Just as an aside, in calculating that, what you do is you apply the tax rate to those distributions after you've applied the lower marginal tax rates to their other income that they earn. So critically important to look at and assess that. So that's basically the quick snapshot of why you'd be looking at an ILP. Some of the bits and pieces and details around that give you a little bit more insight into how the mechanics of it works. So if there's any more information that you'd like to get from me in relation, we've just got a couple of questions. If you can just email me at matt@fwa.net.au, or alternatively give me a call on 3833 999 at any time. I have clients all up and down the eastern seaboard, throughout Queensland, Sydney and its surrounds, and then in Melbourne and regional Victoria. But as a one-off for today, if you are contemplating your ILP strategy and and that's something that is imminent, you'd like to just run through with me in detail, I'm more than happy for the 5 people to email me at matt@fwa.net.au to book in a free 45-minute online consultation where we can just talk about the benefits and talk through your strategy, just to make sure that it's all on track. As I said, it's free and no obligation. So please avail yourself of that if that's something that you're considering at the moment. I do many of these ILP restructures a year, so usually there's no questions that people pose to me that I haven't seen or heard before. So also just keep your eye out for our next webinar, which will be 12 noon Australian Eastern Standard Time on the 15th of November. It's thinking of incorporating your legal practice part 2. In that webinar, what we'll do is we'll go through some of the mechanics and the details of showing you, the benefits of debt reduction, say in an ILP. Look at in a little bit more detail some strategies that you can employ in applying the small business CGT concessions as part of your overall planning. So look, thank you very much for your attendance today. I hope that was of value to you. If you'd like to take up my offer of a free 45-minute one-on-one online meeting to discuss your ILP strategies, first 5 to email me at matt@fwa.net.au. Thank you, and we'll see you in another month's time.